get across to Julia Lee, who joins us this morning from Bell Direct. Julia, good morning. What do you make of the Dick Smith sale that we've heard about today?
Brooke, it's taken 8 months to sell this business. In the last result, we saw $120 million worth of impairments related to this business, and that takes the total amount of impairments to $420 million. We know that the carrying value or the book value for this business was at zero, but it is on the lower end of expectations. Yesterday, the Australian Financial Review broke that a sale could go through between $10 to $50 million, and we've seen it going through at $20 million. But I think there will be a sense of relief in the market because the sale has taken longer than expected, and there had been some speculation that perhaps this sale could have run into some issues. If we have a look at the $35 million sale of the Indian business, this is quite an interesting one. So this is the Woolworths wholesale business. It's a subsidiary. It's an Indian subsidiary, and they've sold it to Tata Sons. And I guess really just closing the book on their ambitions in India, because it is very difficult in terms of foreign direct investments. Now, Woolworths did provide technical as well as sourcing for Tata Sons, and there were some agreements in place there, but altogether it does look like Woolies just concentrating on Australia and growth in Australia through its Masters rollout instead. We don't really see any changes to Woolworths' current year forecast. If we have a look at FY13, they're still forecasting between 3 to 6% growth. Key driver of the stock is still the very difficult environment in that food and liquor space, given the competition with Coles. And if we have a look at Woolworths' share price over the past year, it's actually been quite a good one. In fact, if we have a look at the peak that we saw earlier on in the month, that peak is the highest that we've seen for Woolies' share price in around about 4 years. So today, a little bit of profit taking, down by about 0.9%. But I don't think it's really in reaction to the news release today.
Well, from a down sort of session to a soaring stock by contrast, all things being equal, 2% lift for Domino's. Every time we go to the stock, it seems to be only one-way traffic. What do you make of the price action?
This is a very impressive looking chart. If I bring up Domino's over the past year, what you'll see is that the stock has risen by 50% over the past year, and today the gains just continuing. And it is on the back of news that Domino's is planning to return $30 million back to shareholders. So that equates to about 42.8 cents per share. It will be a capital return, and it will be done in two tranches, one in December this year and one in June next year. It looks like they've opted to return excess surplus capital shareholders via this method instead of a special dividend, because Domino's doesn't have a huge account of excess franking credits, so they are saving their franking credits for the dividends that they'll need to pay out. And that's really because they don't only pay tax in Australia, but of course they've got their European business as well. So they own the Domino's license in Australia, New Zealand, as well as Belgium, the Netherlands and Monaco. Now, if we have a look at Domino's, this has been a company which has a very strong revenue model but a low cost model, and it's been doing well, and the rollout into Europe and the expansion into Europe should help to underpin growth. But given that we have seen a huge move in its shares over the past year, despite the capital return, the shares looking pretty fairly valued at these levels.
So you kind of missed out if you were hoping for being along for that 50% plus ride. Well, sorry, you should have paid more attention to you, Julia, several months ago. Hindsight and all that.
Julia, broader market, just thoughts on where this is all headed today. European concerns, we're talking a lot about them. The market's not kind of taking fright necessarily. We're down about 0.4%.
We're just travelling along, not a lot of volume in the first hour of trade. It is expected that volume will pick up over the next session, and that's because today is single stock derivative expiry. If we have a look at the first hour of trade, this is what it looks like for the ASX 200. You can see we've just been bouncing along over the last 40 minutes, looking pretty flat there, but overall the market down by 0.3%. In terms of sector performance, we are seeing losses across most sectors. In fact, all sectors are trading lower with just one exception today, and that's the telecom sector. So it does look like safety outperforming once again. The material space is one of the areas which is dragging our market lower. So that's the 6th consecutive day of losses for the miners there. But lots of company news to be absorbing on the market. We're seeing Echo Entertainment down by around about 1.3%. It's on a search for a new CEO. We've seen Buru Energy down by 1.1% after a $40 million institutional capital raising. And one of the best performers today is Noble Minerals. This is a stock in the All Ordinaries Index, and the stock has soared by a massive 25%. Now, this is on news that a Chinese investor is looking to inject about $85 million into this particular company, and that's really set the stock on fire, and he will be paying a premium to get that stake in the business. So they'll be owning a 41.5% stake and have options to increase that above that 50% level, with some options that they've bought into as well. So lots happening on the market. The next thing and the next catalyst for the market will be in about half an hour's time, where we will see China industrial profit numbers come out for the month of August. Then in the month of July, we did see a decrease of 2.7%. And given that the two key market concerns are at the moment are growth from China and the European situation, this one's going to be watched by the market closely.